fascinating about what's happening with capital in the market right now. Everyone's talking about that it's hard to raise money, generally speaking, particularly in the US. We've gone through a real moment in time where the real estate markets have been repriced. There's a big bid-ask spread, and as a result, capital has really dried up. So a lot of the institutional capital has been sitting on the sideline. Outside of credit, there haven't been a lot of equity deals because pricing hasn't corrected yet. So we're seeing a moment in time where there's kind of a dearth of capital. And a lot of managers are out there going around trying to raise money on traditional sources. That's fine, they should. That capital is going to start coming back into the market. We're seeing allocations increase again this year in anticipation that with high interest rates, assets are going to start selling. And with that selling, we're going to see more and more capital coming to the market. That's a good thing. We need this thing to open up. I think that what groups are missing, and something we talked about earlier today, is that there's a new capital source that's really coming into the market. Well, not the traditional institutional capital sources, but wealth capital, insurance capital, retail capital, high net wealth capital. This actually is going to dwarf traditional institutional capital. And it's searching. Traditionally, it's been focused on public markets. It's searching for ways into the alternatives. And some of the big firms out there have realized this. They're looking at those channels. We're looking at it the same way. And I'm trying to tell managers and institutional capital to realize this is coming. In many ways, that's a good thing. In many ways, it's going to propel assets and propel asset pricing. The flip side is over time, as more and more of this capital comes in, it's going to start, I think, mispricing risk a little bit. So I think one thing that we all have to be cognizant of thinking about going forward is like, where do we go to, one, capture this capital if we're going to be raising money, but also how to circumvent some of that capital in order to get the returns that we want. As sellers, it's wonderful to have that. As buyers, it could be tricky. So we need to focus on nichier asset classes that are harder to acquire, less institutional. Those tend to be more fragmented markets. That's going to generate higher returns, and that's new capital is coming in. It's not ready for that. So that's where we're going, and we recommend other people do the same thing.